Salute, folks. You know who it is. You know what to do. So let's take a look here, because I want to talk to my mortgage professionals really quick. We're gonna go to ChatGPT and look at something that I did on a live stream on my YouTube. Because I want to create this particular clip specifically for the real estate and mortgage professionals that I know personally that apparently have no idea of the power of life insurance. So let's go. Life insurance versus 401k mortgage, right? So I typed into this morning into Chat GPT. I typed into them, and we're going to see explain using life insurance as collateral for a home purchase. ChatGPT responded, using life insurance as collateral for a home purchase is a strategic way to leverage the cash value of a permanent life insurance policy to help you secure a mortgage. This can be beneficial for meeting lender requirements or improving your borrowing terms. Here's how it works, and here's why you might consider it. How it works. 1. Establish cash value. First, you need a permanent life insurance policy that has accumulated significant cash value. This is only possible with whole life, universal life, index universal life, or variable universal life insurance policies, not with term life insurance. As an aside, on a personal note, I would likely exclude variable universal life insurance just because of the variability of it. 2. Assign the policy as collateral. Instead of withdrawing cash value or taking a loan from the policy, you can use the cash value as collateral with the lender. The lender would be listed as the collateral assignee on the life insurance policy. This means that if you default on the mortgage, the lender has a claim to the policy's cash value to recover their loss. Now, how many mortgage loan officers out there who are closing, let's say, 10 mortgages a month would rather do this to close 20 mortgages a month? Step 3, collateral assignment. This is a temporary transfer of rights. You still own the policy and maintain control, but the lender has secured the interest in it until the loan is repaid. Once the mortgage is paid off, the collateral assignment is terminated and full control of the policy reverts to you. 4. Qualifying for the mortgage. Using the life insurance policy as collateral, you may meet the lender's requirements for reserves or secure better loan terms, especially if you lack sufficient liquid assets. Example scenario. Let's say you want to purchase a $500,000 home and need a 20% down payment, $100,000. You have an index universal life insurance policy with a cash value of $120,000. Instead of taking out a traditional cash value loan or withdrawal, you opt to assign the policy as collateral for the mortgage. The lender sees this as additional security, improving your chances of getting approved or obtaining better interest rates. Pros and cons. Pros. It improves your borrowing power. Having life insurance as collateral can make you more attractive to lenders because it adds an extra layer of security for the loan. 2. It preserves cash flow. Instead of liquidating assets for your down payment, you can keep your money working for you within the life insurance policy, allowing the cash value to continue compounding. 3. Flexible repayment. If the policy has a strong cash value, it could potentially cover mortgage payments in the event of financial difficulty, reducing the risk of foreclosure. 4. Continued protection. The death benefit remains intact, offering protection to your beneficiaries even while the policy is assigned as collateral. The lender only claims the amount needed to satisfy the loan. The rest goes to your beneficiaries. Cons. Limited access to cash value. By assigning the cash value as collateral, your access to the policy's funds may be restricted. You might need the lender's consent to take loans or make withdrawals during the collateral assignment period. But why would you if you're assigning the policy? You're purchasing that policy for the purpose likely of obtaining the mortgage. 2. Potential policy lapse. If the cash value depletes due to unpaid loans or market conditions in certain policies, meaning the variable, which is why I wouldn't use a variable, the policy might lapse, leaving the lender without collateral. Right, but part of the collateral assignment states that you can't let the policy lapse. Otherwise, your entire loan is due immediately. It's kind of like when you refinance and then don't pay your payment. The loan is due in full immediately, or you try and sell the house right after getting the mortgage. Tax implications. If a policy loan is taken and the policy lapses, it could create a taxable event on the outstanding loan amount. Then ChatGPT graciously created a chart comparison with 401k loan for mortgage down payment, because you always hear these mortgage lenders tell you to borrow from your 401k, which is helping them because they're going to close a loan and get points, but it's fucking you because it's taking money out of your retirement. Let's look. Life insurance as collateral versus 401k loan. The factor. Impact on retirement savings. Life insurance as collateral? None. It preserves your retirement funds. 401k loan? It reduces your 401k balance. So if you had 200,000 and borrowed 100,000, now you're only earning interest on 100,000. Whereas if you had 200,000 in the life insurance, assigned it as collateral, or even borrowed 100,000, due to uninterrupted compound interest, you're still going to earn interest on 200,000 in that life insurance policy. Let's look at another factor. Access to cash value. It is restricted during the assignment, meaning that the collateral assignee, the mortgage lender, ain't really going to want you going and accessing the money. While as with the 401k loan, you have full access, but with a repayment obligation. This is a huge one here. Credit impact. With a life insurance loan or collateral, there is no direct credit impact. While on a 401k loan, there's no credit check, but it does increase your debt to income ratio, which can then change your ability to qualify for said mortgage. Let's look at the next line. Tax considerations. Generally, there are no tax implications with a life insurance loan or a collateral assignment. However, there are potential penalties and taxes if not repaid on the 401k. Policy growth. Cash value continues to grow in the life insurance policy. However, on the 401k, there is no growth on the borrowed 401k funds. Who should consider this strategy? High net worth individuals who want large, well-funded policies, who want to use existing assets without liquidating them. Entrepreneurs or business owners often use life insurance as collateral when they may not have immediate access to cash, but have significant wealth tied up in assets. Investors seeking leverage. People looking to maximize their borrowing power while preserving their investment growth. Key takeaways. Leverage without liquidation. Using life insurance as collateral allows you to leverage your assets without disrupting their growth. It protects your heirs. The death benefit remains intact for your beneficiaries, only impacted by the lender's claim in the event of default. Flexible financial tool. This approach can be a strategic way to secure a mortgage, enhance borrowing power, and maintain liquidity. In summary, using life insurance as collateral is a sophisticated strategy that can enhance your borrowing options for a home purchase without compromising your cash flow or liquidating long-term investments. It's a great fit for individuals with substantial cash value in their policies who want to leverage their life insurance to achieve real estate goals. So, ladies and gentlemen, you might say, well, it's going to take time to build up that money in a life insurance policy. What do you think it takes to build up money in a 401k? The same amount of time, if not more. That's it for today, folks. Wipe ass. Work in progress every day and see success. Salute.